Reserve has just announced that it will be raising interest rates yet again, which means that the cost of borrowing is going to cost more. Now, that has an impact on things like mortgages, for instance. So if you're looking to be a home buyer, taking out a mortgage will cost you more because the interest rate associated with it will be higher. But as a result of this, what we're noticing is more and more banks are offering up adjustable rate mortgages because they seem a lot better because they have a lower interest rate than a 30-year fixed mortgage. Now, an adjustable rate mortgage is named accurately because the rate is adjustable, meaning that you might pay a lower interest rate for a specific period of time, but after that specific period of time is over, your interest rate can go up. And while there are some regulations in place to ensure that these ARMs, or they're called ARM mortgages, adjustable rate mortgages, don't cause the kind of pain and suffering they did in the financial collapse of 2008, there's still a lot to be concerned about, especially when you look at how much housing has increased in price. So associating, those high costs with a mortgage that has a higher interest rate in the future is a problem. So let me go through the details. Hopefully you guys can understand this. It's easy to digest because this is an issue. I see this as a big problem. So the average rate on a 5/1 ARM, adjustable rate mortgage, one of the most popular adjustable rate loans, was 4.93% this week, more than a full percentage point lower than the 6.02% average rate for a 30-year fixed loan, and that's according to Freddie Mac. Now, a 5/1 ARM has a lower fixed rate for the first 5 years and a variable rate based on one of several market indexes for each of the remaining years of the loan. Okay, so one thing to keep in mind is sometimes you'll hear bankers say, you could always refinance though. You could always refinance. Or they'll argue, well, it's an adjustable rate mortgage. It doesn't mean you're gonna be paying a higher interest rate after the 5 years are up. Interest rates could actually be lowered. You might end up paying a lower interest rate, except that's not gonna happen. It'll be a higher interest rate, okay? 100% it will be a higher interest rate. Now, again, the 5/1 refers to two key things that you should keep in mind. So the 5 number represents the fixed period of the mortgage, okay? The fixed interest rate for the first 5 years. And then the 1 in that 5/1 adjustable rate mortgage represents how many times a year the interest rate can change after those 5 years are up, okay? So they won't be able to, under an agreement with a 5/1 adjustable rate mortgage, they won't be able to change or adjust the interest rate several times in one given year, which is good. But there are different kinds of adjustable rate mortgages, and if anyone is proposing that you go for one of those mortgages, just make sure you're fully aware of what you're getting yourself into. Now, this time last year, homeowners were getting mortgage rates as low as 2.86%. So as you can imagine, if interest rates go up to 6%, then an adjustable rate mortgage with a lower interest rate for a certain amount of time might seem more desirable. Now, the use of adjustable rate loans surged in recent months. As of August 2022, more than 9% of all mortgage applications were for adjustable rate mortgages, according to the Mortgage Bankers Association, which was up from 3.3% this same time last year. And what I keep hearing from business reporters is, but we don't have anything to worry about. We shouldn't be worried. No one should be worried. Like, divert your eyes, it's not a big deal. Because we passed super weak sauce regulations. The Dodd-Frank bill ensured that the predatory behavior, the predatory lending that was taking place by these big banks would stop. And you know what? They're right about the big banks. But they forget to mention these so-called non-bank institutions, or they're sometimes called shadow banks, where they're not considered one of the big banks, but it's a financial institution that will lend money. And if you look at the data, they typically lend to people who are a little risky. Their credit scores are much lower. There's evidence of them defaulting on loans in the past, but they go for it anyway. and they don't have to abide by the same regulations that the big banks have to abide by under Dodd-Frank. So that's another thing to be a little concerned about. Now, months ago, the New York Times reported this. They reported that last year, no more than 4% of mortgage applications for adjustable rate mortgages. Let me read that again. Last year, no more than 4% of mortgage applications were for adjustable rate mortgages, said Michael Frattitoni, who's a chief economist over at the Mortgage Bankers Association. This year, he said, the share has risen to about 10%, driven by the rise in interest rates, which of course is fueled by the Federal Reserve attempting to do something about inflation. So let's talk about the safeguards. I've talked about it a little bit already, but let's talk about what regulations are in place today that weren't in place prior to the 2008 economic collapse. So first of all, those risky adjustable rate mortgages that let borrowers pay an interest rate of their choosing for a brief period of time, that's gone. Those were so-called teaser rates. And I mean, if the bank tells you, you get to choose what your interest rate is for this period of time, it's probably going to lure you in and persuade you to take out a mortgage that could actually end up having an interest rate that makes your mortgage unaffordable. That's all gone. That part is gone. They don't allow that anymore. Now, compared with adjustable rate mortgages available before the financial crisis, which offered low teaser rates and allowed rates to be reset quickly, today's adjustable rate loans are safer, mortgage experts say. They typically have a fixed rate period of at least 3 years and limits on how often and how much the rate can rise after that, such as one change per year of no more than 2 percentage points. But not all of those adjustable rate mortgages follow those guidelines. So there are some examples of the interest rate increasing significantly once that fixed rate period is up. Some loans allow a larger increase at the first reset, often 5 percentage points above the starting rate. Guys, that is huge. 5 percentage points is massive, absolutely massive. That will definitely make a mortgage to the tune of hundreds of thousands of dollars far less affordable for the typical American. I mean, before the pandemic, nearly half of Americans were living paycheck to paycheck, couldn't even afford a $400 emergency, and that was according to a study by the Federal Reserve. So a mortgage increasing its interest rate to something that's 5 percentage points more, that would be devastating for people. But let me continue. So 5 percentage points above the starting rate, then allow increases of no more than 2 percentage points. And that's according to Sean Block, a mortgage broker on Long Island. So he's a mortgage broker. Homeboy knows some of these adjustable rate mortgages, they might screw you. And so I tell you this, number one, to just tell you to be careful if you're looking to take out a mortgage. But the bigger picture, I think, is also incredibly important. Our economy goes through cycles and will experience a devastating economic collapse. Congress will come in and do a little bit of tinkering with regulations and congratulate themselves for doing something big when in reality they haven't done enough to rein in corporate greed. And then you see the same behaviors take place again. And I've been seeing this creep up more and more. I've seen a lot of questionable activity with these shadow banks. I've seen a lot of questionable activity with the increase in the number of adjustable rate mortgages. They love to say that they have stricter lending standards, but do we just take their word for it? And keep in mind, what led to the economic collapse was that the big banks were giving out predatory loans. They were bundling up those loans and trading them on the stock market in the form of mortgage-backed securities. You had pensioners, you had retirees invested in mortgage-backed securities that were full of mortgages that were going to default. And guess what the big banks did? They bet against those mortgage-backed securities because they knew they gave out loans to people who were likely gonna default in the future. So mortgage-backed securities, still a thing, still in the stock market. People are still invested in them. So if the same activity happens again, if we're starting to see it bubble up again, It could be yet another devastating economic crisis in this country, and it'll just show us that we've learned nothing yet again.